I think there's another good quote on this from Roger Lowenstein, who's the author of When Genius Failed, which is a book that details the rise and fall of the hedge fund long-term capital management. We have not had Lowenstein on, but we did have Victor Hagani, who was one of the partners at LTCM. He was on Rational Reminder, and he talked a little bit about his LTCM experience. So Lowenstein, he wrote a book about that. He wasn't part of it. So Lowenstein is paraphrasing Eugene Fama's work on fat-tailed distributions, but he says in the book, as Fama put it, life always has a fat tail. Extreme events happen a lot more frequently than people like to imagine. The world life is not normally distributed. I think that poses challenges for financial models that don't capture fat tails, which is kind of what happened to LTCM. They had a model that didn't account for how fat the tails were in the assets they were investing in. But I think it also poses challenges for how individuals plan their futures. The nature of risk and uncertainty just make investing and planning for the long term inherently uncomfortable. Volatility being the price of admission for higher expected returns is a real thing, but financial product manufacturers and fund managers know that volatility and enduring volatility is a struggle, and they'll often cater their sales pitches to those types of concerns that investors have. So that leads me to
Market-linked
another.
GICs, we're
Well,
talking about you.
That's exactly the example that I have actually.
Yeah.
I said structured notes, but it's the same kind of concept. And so this one's really important, right? Where it's like, okay, we know life has fat tails, so people are worried about the future. We know we can't predict the future. We know volatility is scary. And so banks and financial product manufacturers are like, well, hey, do I have something for you? But this is a quote from economist John Cochrane, who we've had on the podcast twice. He says in one of his papers, when having dinner with lions, make sure you're at the table, not on the menu. So we know financial markets are extremely competitive. If someone wants to sell you something, whether that's a stock, whether you're buying a stock on the stock market, or looking at a financial product, could be a fund or a structured note or a market-linked GIC, you need to ask yourself, why does this person want to sell me this product? What do they know that I don't? What's in it for them to sell me the product? What's in it for me as the investor? Are you entering into a mutually beneficial transaction, or are you about to be eaten alive by the lions? And there are a ton of financial products out there that cater to the fears and biases of retail investors in exchange for ridiculously high fees and costs, putting retail investors, I would argue, on the menu. Structured products are like the most egregious example because they use pretty significant complexity. Like we had a couple of academics on to talk about structured products, and it's like it's hard for them to do the analysis and figure out what does this thing actually contain? What are the underlying payoffs of this product? And so their argument, and I think the academic argument in general, is that financial companies use complexity to shroud high embedded costs, like really high, like 4 to 5% or even higher.
Yeah,
I think this is, yep.
No, I was just going to say it really comes down to kind of one promise that all of these products have in common, and that is stock-like returns
Right.
without the downside risk.
Yeah.
And anytime you hear any product advertising something like that, it's impossible.
Yeah.
Just so you know.
Yeah.
And
Nobody's taking the other side of that trade.
yes, exactly.
Right.
So volatility is the price of admission,
That's
right?
right.
You can't sneak in the back door.
No, there's no back
Yeah.
door. Now that piece is really important to understand because fees and costs are one of the few things that investors can control. So John Bogle, the late founder of Vanguard, who is someone that I wish we'd had on this podcast while he was alive. It's a shame that we didn't. He's got this great quote. The grim irony of investing is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So he's speaking to the fact that in aggregate, investors have not benefited from paying higher fees to active fund managers who aim to beat the market. Instead, investors have underperformed roughly by the amount they paid in fees. So Bill Sharp has referred to this as the arithmetic of active management. In aggregate, active managers must underperform index funds because both groups hold the market, but active has higher fees and costs. There is some nuance to that, which we've covered in past videos on kind of the how that changes a little bit when you introduce trading. But I think as a model, the arithmetic of active management still has really, really valuable insights, and it's more true than not. Basically, unlike other areas of life, in investing, it is really difficult to expect a better outcome by paying higher fees. It's in fact the exact opposite, which makes fees and costs a really important criteria in evaluating any investment.
It's one of the few activities that we do, right, where you don't get what you pay for. We, in so many endeavors in life, right, we think not only how much money but how much time you put into the activity generally produces better outcomes. But when it comes to things like stock picking and investment selection, it's just not true. And in fact, as you said, usually the opposite is true.
Yep. Yeah, I agree. But you're right, both on fees, but also on time. The more time you spend, I didn't have it in here, but that the portfolio is like a bar of soap. The more you handle it, the smaller it gets. That's
Yeah.
another good quote that's similar.
Yeah. I hear it sometimes too when people talk about, indexing or passive strategy is fine for people who don't have the time to put in the work. And, this is where you look at institutional investors who use these strategies. And I think, do you honestly think that they don't have the time and resources to put in the work? Of course they do. The point is the work doesn't pay off, right? And I mean, we have just so much evidence showing that that's the case, but it's a myth that will persist, right? Because it's so counterintuitive.
Yeah. It makes me think of that Barbara and Odine paper. I think it's called Trading is Hazardous to Your Wealth. But they found that in retail investor accounts, it's an older paper and an older data set. But the accounts that traded more had kind of like monotonically lower returns. So it's the same kind of thing. The more attention you pay to your portfolio, the worse you do.
Yeah, there's this apocryphal study. I've never actually seen it, but people have invoked it where they did some study and they found out the best performing investors were people who had died and they their estate didn't know that they had an account.
The Fidelity study.
Yeah, my guess is that's not actually true, but it probably would be true if anyone actually examine the data.
Yeah. I love that example. I wish the paper actually existed, but like you said, I don't think it's actually real.
Yeah, I doubt it.
It's a great story though. There's John A. List. We had him on Rational Monitor a while ago. He has a paper on, I wish I could remember the details, but it was like people who check their portfolios more frequently tend to take less risk and have lower returns. So kind of speaking to the myopic loss aversion thing. So it's like paying more attention to your investments doesn't seem like a very good idea.
It's funny that you say that because that is a question I tend to ask clients when we're determining or reviewing an asset allocation. So we've been working with a client for a number of years, and I'll often say to them, how often do you check the account? And you get all kinds of answers, right? I get people, I check it every day, sometimes more than once a day. And I get people who laugh and say, I literally don't check it until the day before our review meeting. And I have to think about that, right? Because people who check it every day, and if they have an aggressive asset allocation, then I thought, well, you must be comfortable with volatility because your portfolio is volatile and you are seeing it. If you have another client who might have a fairly aggressive portfolio, but they never check it, they might actually be quite sensitive to volatility. They just are not, it's not in front of them. And so I think you have to treat those situations a little bit differently. It's not to say that you have to change the asset mix of one or the other, but it is something, I think those are two different situations, right? You have the same asset allocation, but you have a client with a very different approach to volatility and risk.
Yeah, that is interesting. Okay, this next one is generally attributed to Mark Twain, but Dan, you and I were chatting earlier that it's sometimes hard to pin down the actual attribution of these quotes, like who really said it first. Anyway, so this one's generally gets attributed to Mark Twain, but it's sometimes debatable about who actually said it first. The quote is, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Investing is a discipline that, due to its inherent uncertainty and risk, as we've been talking about, contains a huge amount of noise. It's really difficult to be certain of anything in financial markets, other than the fact that there will be a lot of uncertainty. So I think anytime that you're sure of something, like, real estate always goes up. This crypto token that I found is going to the moon. Tech stocks will always beat the market, as they have for a while now, and so on, stuff like that. I think anytime you have that level of certainty, you've got to step back and remind yourself that the only certainty in investing is uncertainty. If In addition to discipline and psychological fortitude, I think successful investing requires a good dose of humility and skepticism. If you go all in on a single stock and end up being wrong about it, you could be setting yourself back permanently. It's not uncommon for single stocks, as we talked about in a recent episode, to drop 60% or more and never recover. That's actually a pretty frequent outcome for individual stocks. If you start with a total market index fund and tilt a bit toward something like small cap and value stocks, just as an example, being wrong might lead to a bit of underperformance, but the risk of permanent capital impairment or total loss is minimal. So I think that humility is important, which leads to the last quote that I'll share here. And I know you've got one more, Dan. Harry Markowitz is paraphrased as saying, he never actually said this as far as I could tell, but it's kind of paraphrasing his work. Diversification is the only free lunch in investing. So typically, as we've mentioned, volatility is the price of admission for higher returns, higher expected returns. Diversification is this rare case where adding multiple imperfectly correlated risky assets together in a portfolio can allow you to increase expected returns without increasing risk, or decrease risk without decreasing expected returns. Diversification also mitigates the damage if a single investment in a portfolio does not work out. The downside of diversification, of course, is that it makes it less likely that you'll hit big home runs. But due to the skewness in returns, in individual stock returns, you're far more likely to end up losing than winning with a concentrated portfolio. So to me, diversification is a form of humility, really.
Yeah, it's interesting too that we're kind of finishing with this quote, because one of the earlier quotes we had was about how much conviction you need to have in your investment philosophy. And I was almost going to jump in at that point because I'm saying that's true, but part of a conviction is like, what is my conviction in our investment strategy, which is, a pure indexing approach. My conviction is that we don't really know anything, right? So it's not so much conviction that I have a lot of confidence in very specific investment choices I'm making. It's almost the opposite. It's recognizing that so much of what we do and so much of the outcomes that we can expect, we really cannot anticipate. And so it's almost a confident humility. I know it sounds silly, but it's really, getting back to what you're saying is you have to be understanding that because we don't know a lot, the future is unknowable. The only rational response to that is diversification.
Yep.
So I have confidence in diversification, which in and of itself doesn't have a lot of confidence in any specific investment strategy. So
you've got confidence in your lack of confidence.
Exactly. Yeah. I think I've tied myself in knots, but I hope the point is clear.
Yeah, no, it is.
Yeah. So I just wanted to round out with one, because I went back when we started to think about, these telling quotes is kind of early on in my investment education, what quotes really resonated with me. And it was John Bogle's book, Common Sense, and the Little Book of Common Sense Investing. One of the first, really approachable books that turned me on to indexing as a strategy. And his quote was, "Don't look for the needle in the haystack. Just buy the haystack," which is just such a great metaphor, I think, for total market index funds. You will always have all of the winners if you buy the total market index fund. And that one has really stuck with me over the years.
Yeah, that's a very good one. Okay, so you got one more after this too, one more quote. But so this was a ton of information. Obviously, we went through a ton of different quotes on a ton of different topics. I think it all boils down to a few key principles, though. Spend less than you earn. Pay yourself first. Keep enough cash on hand for near-term expenses, so you don't have liquidity problems. Invest in a portfolio and invest your long-term assets in a portfolio with expected returns sufficient to meet your long-term inflation-adjusted goals, which is really a financial planning question. It's not one that you can answer just by sticking your finger in the air. You have to really go through and project what your future expected needs are and figure out what asset allocation makes sense for you. Constrained, obviously, by the behavioral stuff we talked about. Choose an investment philosophy and asset allocation that you can stick with, even when they don't seem to be working. I think that point is huge, because any investment strategy will go through periods where it really sucks to own and other stuff is doing better, but you've got to be able to stick with it. Like the ARK example, it looked really smart for a while, looked really dumb for a while, but over its full life cycle since it's existed, it's actually done okay. Don't panic when the market drops. Don't chase recent past performance. Don't try to time the market. Maybe those are all saying the same thing in different ways. Be prepared for the future to be different from your current expectations. Be aware of the fees and costs that you pay, and don't be too sure of anything, and diversify broadly.
Yeah, this I did have one last quote here that kind of summarizes all of those things. This is a really great one from Alexander Green's book, The Gone Fishing Portfolio. And right early in the book, he just notes like, there are several things that will affect your portfolio over time. And those are the amount you save, the amount of time that you give the portfolio to compound, the asset allocation that you choose, your expenses, your costs, and your returns. And if you're listening carefully, you will know all of those are within an investor's control, except the last one, and that is investment returns. And as he puts it, no matter how proficient you are as an investor, you cannot control your portfolio's annual investment returns. And yet this is the factor that so many investors spend their time fretting about. So it's just a great reminder, focus on what you can control. We have zero control over what the market will do, but if we control all of those other factors in the portfolio, that's really all anybody can do. And, if history is any judge, that for the vast majority of people, that is going to work out if you can control those important factors.
Yeah, that's a great quote to finish on.